As the stock market continues to drop, it's getting to levels where I'm buying more. And if you're someone who's just getting started, it may sound counterintuitive, but trust me on this, I'd much rather buy stocks as they're falling than when everything's already high. I'll explain why a bit later, but for the beginners, I hope you're ready for a journey of a lifetime, because once you start, you wouldn't want to ever stop. And if you've been investing for a while now, you may still find some value in this video. And if you do find value, do me a favor and give it a thumbs up. First things first, you need to understand what your risk tolerance level is. Are they high or are they low? Because there's levels to this. If you're just starting out, then maybe you should stick to things that aren't so risky. Stocks that are very low risk are called index funds, and individual stocks are considered very high risk because if their sales slow down, then the stock will probably drop. Whereas index funds hold dozens and even hundreds of individual stocks in them. If that doesn't make sense to you, then it's okay. I'll explain. If you'd like to buy stock in Apple or Tesla, Microsoft or even Home Depot, well, you can. But those are all considered high risk because they're individual stocks. And all those individual stocks have what's called a ticker symbol, where you can look them up on any broker's account like Robinhood or Fidelity, and you can see how much it costs for one share and you can buy it. Apple, for example, has the ticker symbol AAPL, Tesla's is TSLA, Microsoft is MSFT, and so on. Every single individual company that's open for everybody to invest in them has a ticker symbol, and so do the biggest index funds. One of them you might have heard is the S&P 500. Their ticker symbol is SPY. This one ticker symbol holds the top 500 companies in the US. So instead of buying one share of Apple, one share of Microsoft, and one share of every other major company that's out there, you can buy just one share of the S&P 500, which again, ticker symbol SPY, and you can be invested in the top American businesses. And that reason why it's not so risky like individual stocks, because if one of the companies that you invested in has a bad month, because let's just say that they're getting sued for $1 billion, then the individual stock may drop 10 to 20%. Whereas if you're invested into the S&P 500, it wouldn't react as much because it has hundreds of other companies holding it up. I hope that makes sense to you. So the S&P 500 is one of the least risky stocks that you can buy in the stock market. And it's actually what most people's retirement accounts follows. But as you may know, the least risky something is, the less of a reward that you can get, which means that you'll get less of a return. For example, the S&P 500, it averages around 10% per year. But it's still 10 times better than having your money sit in a bank account doing absolutely nothing. Also, as a side note, you don't need to buy an entire share of a stock. You can always buy parcels. The S&P 500 is around $670 a share, but if you like, you could also just put in $200 in it, or however much money you'd like, and that goes for any stock. If you'd like to be a bit more risky, then there's another index fund that you can buy, and that is QQQ. As I just mentioned, QQQ is an index fund, but instead of holding the top 500 companies in the US like the S&P 500, QQQ holds the top 100 companies, and over half of them are in the technology sector. So if you'd like to be invested in AI without adding too much risk, then this index fund holds the biggest AI companies that you can think of. And if you also think that technology is a now and the future, then this one might be for you. As long as you know that whenever there's a market crash, tech stocks are always the ones that get hit the most. However, in that same token, whenever the market goes up, tech stocks are typically the ones that go up the most. QQQ averages a yearly return of almost 15%. The best thing you could do with buying index funds is to buy them every week or every other week and not to panic whenever it drops. Please don't panic when it drops because it will, and there's going to be times when it drops a lot. So just keep in mind that this is for the long term, not for tomorrow. And also keep in mind that you won't ever lose money unless you sell. So don't panic like everybody else. Think of it like this. You've been eyeing a nice pair of shoes online and you see that it costs $500. You think that's a bit pricey for your liking, so you don't end up buying them. You look online a month later and you see that the price went up to $550. You're furious. I should have bought them last month. You're annoyed at yourself for not buying them when it was cheaper. You let 2 months pass by and decided to look online again, and to your surprise, those same shoes are now $299. So you get excited and you buy them because now they're at a huge discount. Those shoes went from $550 to $299. That sounds like a great deal, right? That's how you should look at the stock market, especially index funds. Seriously, when the price drops, it means that the stock is at a discount. And that one simple mind exercise will separate yourself from 90% of people out there. Also keep in mind that the S&P 500 has never not recovered after a crisis. The crash in 2008 and 2009, well, the S&P 500 has gone up over 700% since then. Do you remember the shutdown during the pandemic in 2020? Now it's almost doubled. Index funds are meant for the long term, so if you have extra money and you don't want it to sit there collecting dust, I'd recommend buying some shares every single week or every other week, no matter what happens. And when the market's really dropping and you hear all of your colleagues freaking out about their retirement accounts, you need to be the one who remains calm and continues to buy as it drops. Because guess what? You're now educated on it. Trust me, you'll thank yourself in 5 years for doing that. And you'd also be annoyed at yourself for not buying more when it was cheaper. Also, something to always keep in mind is that you'll never lose everything that you invest with in index funds. The only way that's possible is if every single company that's in it goes bankrupt. And if that happens, then I think we'll have bigger issues to worry about. But in summary, the S&P 500 is low risk, QQQ is a bit riskier, and individual stocks are very risky. The average yearly returns for the S&P 500 is 10%, whereas QQQ is around 15%, and individual stocks are endless. But remember, there's nothing wrong with starting small. The most important thing is that you get started. You got this. This is part 1 in the beginner's guide. Be sure to subscribe for part 2.